Welcome to our first mini lecture on Chapter 9. Chapter 9 deals with long-lived tangible and intangible assets. First, let's look at the definition of long-lived assets. These are business assets acquired for use over 1 or more years. In other words, 1 or more means more than one, basically. Anything that is intended to be used up in 1 year or less is considered a current asset as opposed to a long-lived asset. These assets are not intended for resale. Instead, they're considered productive assets in the sense that they enable the business to produce goods or services that the business then sells to customers. Now, there's 2 types of long-lived assets: tangible, which means they have a physical existence, and intangible, which means that they do not have physical substance. So tangible assets are long-lived assets that have a physical substance, and examples of these are land, building, machinery, vehicles, equipment, furniture, and fixtures. And sometimes they're grouped on the balance sheet into a single item called property, plant, and equipment, and they are also known as fixed assets. The second category is intangible assets. These are long-lived assets that have special rights and privileges conveyed by law or by contract, but they have no physical substance. And examples of these are trademarks, patents, copyrights, technology assets, licensing rights, franchises, and goodwill. And we're going to come back to that category in a bit. In this portion of the lecture, we're going to be dealing with applying the cost principle to long-lived assets that are tangible. Okay, so tangible assets, we've got 2 new categories here. These are in addition to the ones we just spoke of. If you remember, land does not wear out or depreciate. However, land improvements do. These are things that are on the land. For example, sidewalks, pavement, landscaping, fencing, lighting, sprinkler systems. And if you live in Western New York, you know that things like sidewalks, pavement, driveways, roadways, they do wear out, they do depreciate and need to be replaced at some point in time, so they have limited lives, whereas land, when it's used as a support for a building or structure, has an unlimited life, so we don't depreciate land. We do depreciate land improvements. Construction in progress is also another new account. It includes the cost of constructing new buildings and equipment, and then when construction is finished, these costs are moved out of this account and into a separate building or equipment account. Okay, now this next section is very important. This is the rule for how to record the acquisition of tangible assets. Okay, so this is the cost principle. All reasonable and necessary costs to acquire, that means to buy, and prepare an asset for use should be recorded as a cost of the asset. In other words, we should debit those costs to the asset account, whatever type of asset that is. We call that capitalizing the cost. In other words, we debit the asset account instead of debiting an expense account. So for land, capitalized costs would include the acquisition purchase cost, any legal fees, commission fees, survey fees, title search fees, and if you have to prepare the land in any way by grading and leveling it and so on, that would be considered part of the cost of the land. So as you pay for these things, you will debit the land account. With regard to buildings, certainly the purchase cost of a building or construction cost if you're building it, any legal fees, appraisal fees, architect fees, all of those would be debited to the building account as you have to pay for those things. And with regard to equipment, again, the cost of acquisition, purchase, construction, any delivery expenses, transportation costs, sales taxes, installation, all get debited to the equipment account because all reasonable and necessary costs to acquire and then prepare that asset for use should be debited to the asset account, and that is called capitalizing the cost. Now, what if you buy a used piece of equipment? For example, a truck. and you have to replace the tires and change the oil and maybe give it a paint job or put your logo on it, then all costs before it is used should be capitalized or debited to that vehicle account. The cutoff is first use. Any cost you have to pay for before first use should be debited to the asset account. After the truck or whatever asset is being used, then it depends. Let's talk about the use of tangible assets, and then we'll come back to a basket purchase in a moment. After first use, any costs related to that asset may or may not go into the asset account. It says here, with regard to use of tangible assets, most tangible assets require substantial expenditures over the course of their lives to maintain or enhance their operation. So, if what you're paying for is an ordinary repair and maintenance, routine maintenance, just to keep that asset in use. For example, oil changes for vehicles. These are recurring and they're relatively small. Because these costs occur frequently to just maintain the asset's productive capacity, they're recorded as expenses in the current period because they benefit the current period. However, if you have an extraordinary repair, replacement, or addition, these are things that occur infrequently. They're large expenditures. They increase an asset's usefulness through enhanced efficiency, capacity, or life. So these would include major overhauls, complete reconditionings, replacements. These costs increase the usefulness of the tangible assets beyond their original condition. They are added to the appropriate long-lived asset account. In other words, we debit the asset account. So we call those capital expenditures. We capitalize those costs. We're going to end the lecture there. Oh, one more, sorry. Basket purchase. This is the case where assets are purchased together. For example, when land, buildings, and equipment are purchased together, we split the total cost among the assets in proportion to the market value of the assets as a whole. Here's page 399 from our text, and it describes just that basket type purchase situation. In some cases, land, building, and equipment are purchased together, such as when Cedar Fair bought 5 amusement parks from Paramount Parks. When this type of basket purchase occurs, the total cost is split among the assets in proportion to the market value of the assets as a whole. So for example, if Cedar Fair were to pay $10 million for a hotel and land surrounding it, based on the appraisal that estimates the land that estimates the land contributes 40% of the property's value and the building contributes 60%. So Cedar Fair would record 40% of the total cost of the land, or $4 million, and 60% they would record, or $6 million, to the cost of the building. So you would debit land $4 million, debit building $6 million, and then credit either a liability or cash for the $10 million. So that ends our mini lecture for the beginning of Chapter 9. We're going to take a break now and look at a problem where we can get a little practice deciding whether something should be capitalized or expensed. When we come back, we'll be talking about depreciation methods in mini lecture 2.